Yes Bank, the profits took a hit on back of sharp rise in provisions for the bad loans. It's been a tough quarter for the asset quality front for the private lender. Net NPA worsened to 0.84% from 0.59% on a QOQ basis, while the gross NPA came in higher at 1.6% versus 1.31% on a quarter-on-quarter basis. However, in some good news for Yes Bank, the net interest income came in higher than the analyst expectations of 2417 crore rupees. And Poonam Sane joins in to give us
123 crore rupees in the current quarter and has recovered or upgraded loans amounting to 467 crores in the September 30th quarter. Given this single loan account which is being lined up for a near-term recovery come upgrade, the bank is reporting a lower PCR for this quarter at 48%. However, the endeavor is to raise the PCR to 60% by March 31st, 2019. So the bank is also disclosing the its exposure position vis-a-vis infrastructure financing group, which has been in the news of late, and the total gross exposure of the bank is 2,600 crores, which is all standard in terms of classification as per September 30th, 2018. In the same group, we would like to report that the bank has no exposure to the parent or the NBFC or the financial services entities of the group. The exposures of the bank are all with the asset-rich subsidiaries or special purpose vehicles, where we believe that the enterprise value of those individual companies are commensurate to the debt level. And with the supersession by the government that has taken place, we are also expecting fresh developments to also take place in the next 90 days going forward.
Con call, Poonam.
Well, Yes Bank reported profits which were fairly below our own poll estimates, and this is on account of fairly higher provisions as the GNPAs rose substantially during this quarter. On the other hand, we did see stable margins at 3.3%. We did see an inline kind of a performance in terms of the net interest income, a strong loan growth of over around 60%, but asset quality was definitely a major disappointment. The GNPAs jumped 37%, the gross slippages jumped to 1,600 odd crore. There was a sale to ARC as well. They did also mention that if you look at the overall asset quality, yes, there is some amount of stress, but they are expecting some amount of recoveries as well coming into Q3 to the extent of somewhere around 600 odd crore. They also did mention that on the con call that in terms of the island affairs, they have disclosed their exposure stands at nearly around 2620 crore, which is mostly towards the subsidiaries and SPVs of Island Affairs, no exposure to the parent company. And they did mention that if at all in a worst case scenario, they would see the credit cost to be rising by nearly around 10 bips versus the current credit cost guidance of 70 bips. They are expecting good amount of recoveries as well coming into Q3 and Q4, and hence they still did not give too much of they still kept their guidance largely unchanged around the 70 odd bips. In terms of the capital raising, Mr. Monga did mention that as of now they will be conserving capital, and also the fact that they would be getting more clarity in terms of capital raising only post clarity in terms of the succession planning, and hence by mid-December probably they will be giving names to RBI in terms of succession planning. So as of now they will be conserving capital. One another reason they also did mention of the rise in asset quality was the fact that they did see good amount of MTM hit on account of the rise in bond yields. So as of now, I guess we probably would see slight overhang in terms of the succession planning, as well as in terms of until we get a full report in terms of the RBI divergence. They still remain fairly confident of not too much of rise in credit cost on account of that as well, but probably overall a weak Q2 for Yes Bank.